Hey people, what's going on? Welcome back to the channel. Hope you're well and in good health. Right now we're on City AM, so let's take a look at this article. Bank of England economy resilient but full force of interest rates yet to come. So let's dive in. The UK economy has weathered the worst of a rapid interest rate tightening cycle this year, but the full force of hikes is yet to filter through to smaller and higher level, basically leveraged businesses, the Bank of England warned. In its financial stability report, Threadneedle Street's Financial Policy Committee said higher interest rates continue to put some firms and households under pressure, but UK corporates in particular were expected to remain broadly resilient to high interest rates and weak growth. In aggregate, UK corporates' ability to service their debts has improved due to strong earning growth, the Financial Policy Committee said, but the full impact of higher financing costs has not yet passed through to all corporate borrowers and will be felt unevenly, with some smaller, higher leverage UK firms likely to remain under pressure. Insolvencies among firms have risen over the past 3 months but remain low, the bank added. The amount of outstanding UK corporate debt relative to corporate earnings has continued to fall since its recent peak during the COVID pandemic. The latest, covering basically the period between April and June this year, shows the corporate debt to earnings ratio stood at 276%, down from 345% at its peak during the pandemic in 2020, a figure that has come into sharper relief in recent years as interest rates jumped. The share of corporates at higher risk has also slumped below the heights seen in 2020, its pandemic peak. However, pressure was still likely to be piled on firms in sectors particularly exposed to economic swings like the retail and the property market, according to the Bank of England's analysis. Now, while the Bank's Monetary Policy Committee has paused its rate hiking cycle and opted to hold rates at 5.25% in the past two meetings, households are likely to come under further strain as rates stay higher for longer in the UK. Some 5 million households face paying an extra £240 a month on their mortgage bill by the end of 2026, as the last cheap fixed rate loans come to an end, the Bank of England has warned. It goes on to say the bank publishes quarterly assessment of financial risk to the economy today, in which it laid out a list of threats still lingering over the UK. The threat of the so-called shadow banking sector to the UK economy has heightened this year, even as traditional UK lenders look to have weathered the worst of economic turmoil. The FCA in the UK has taken steps to boost liquidity and shore up vulnerability of so-called money market funds, but riskier borrowing in financial markets like private credit and leveraged lending is still judged to be particularly vulnerable by the bank. Although there are a few signs of stress in these markets so far, a worsening macroeconomic outlook, for example, could cause sharp revaluations of credit risk, it added. The traditional banking sector, however, is well capitalized and has high levels of liquidity and has seen off much of the volatility that tore through the global banking sector in the wake of the collapse of Silicon Valley Bank and Credit Suisse earlier. Okay people, I hope you enjoyed that video here today. Please do like, share, subscribe, comment below, let us know what you think about the current interest rates and what's impacting financial markets in the UK economy as of the current kind of issues that we have at the moment, post-pandemic, and also with the UK economy not looking so great at the moment. Please do like, share, subscribe, comment below. Catch you on the next one.